7.2, calculating and journalizing depreciation expense. We have one learning objective. You need to be able to calculate and record depreciation expense using straight-line depreciation. We've done straight-line depreciation before, so hopefully most of this is review. The portion of a plant asset's cost that is transferred to an expense account in each fiscal period during a plant asset's useful life is called depreciation expense. There are three factors that we use to calculate a plant asset's annual depreciation. We need to know the original cost. That's going to include all costs that are paid to make the asset usable to a business. We talked about that in the last section. We need to know the estimated salvage value. The estimated salvage value is the amount that will be received for an asset at the time of its disposal. That could be referred to as residual value, scrap value, or trade-in value. So here we're estimating when we're done with this asset, how much do we think we're going to be able to get for it? Or how much do we think it's worth? And then the last thing that we need to know is the estimated useful life. That's going to be the number of years that we're expected to use the asset in the business. So to calculate our straight line depreciation, it says recording an equal amount of depreciation expense for a plant asset in each year of its useful life is called our straight line method of depreciation. They give us an example here. On January 2nd, it says that Vaughn Distributors bought a computer for $4,000. It has an estimated salvage value of $1,000, and its estimated useful life is 5 years. So what we're going to do is we'll take the original cost, we'll subtract from it its salvage value, and that will give us our total depreciation expense. So $4,000 minus $1,000 is going to be $3,000. That tells us that for the 5 years that we are expected to own this computer, it will depreciate in value $3,000. We then need to figure out the annual depreciation. So we'll then take the depreciation expense divided by the useful life, and that will give us our annual. So we'll take $3,000 that we're estimating it will depreciate, divided by the useful life of 5 years. That means each year it will depreciate $600. To calculate book value, we're going to take the original cost of the plant asset minus the accumulated depreciation. So the original cost minus the annual depreciation means after year 1, if we take this is a different, I don't know why they switched it on us, but this must be a different asset. So the original cost of this one was $2,800. Annual depreciation is $600. Ending book value after year 1 then would be $2,200. Now sometimes we might have to figure out for part of a year. So here we see annual depreciation is $240. And to figure out how much it depreciates each month, we're going to divide that by 12. This tells us that it depreciates $20 a month. Now, if we have that $20 a month, and let's say we've only used it for 5 months out of that 1 year, so we'll take $20 times 5 months. That means that partial year's depreciation is $100. We want to make sure that we only depreciate it for $100 instead of that full $240. Alternate methods for partial year depreciation. We have a method that recognizes 1/2 of a year's depreciation in the year of an acquisition. That's called a half-year convention. A method that recognizes a full year's depreciation if the asset is acquired in the first half of the year is called the modified half-year convention. Whatever method a business selects, though, it should be used consistently from year to year. And that's important in accounting, is we always want to be consistent with our methods. So this is recording depreciation on a plant asset record. So this is an example we looked at before filling out this top part. Remember, the third section was for filling out the depreciation. So here we have the annual depreciation. We see in year 1, it looks like when we see here we bought it in August. So we don't want to depreciate it for the full year because we didn't own it for the full year. So here we're just depreciating it for $100 because that's how long we've owned it. So the accumulated is simply 100, and then the ending book value. There's 2 ways to figure out the ending book value for this one. we could take the original cost minus the accumulated, or I should say for the next one, we could take the ending book value minus the new annual depreciation to figure out the ending book value. So 2 ways, it should give us the same number. So we notice then after year 1, we have year 2 that has the full depreciation. We're simply adding that annual depreciation to the previous year's accumulated. We're doing the same thing with year 3, year 4, year 5. Year 6, you can see that we don't have a full year of depreciation, and that's because we can't have our ending book value go below our estimated salvage value. So if we would have done a depreciation for the full annual depreciation, it would have gone below the ending or the salvage value, so we can't do that. So that's why there we only have 140. Okay, calculating accumulated depreciation. I already went through this. So here it has depreciation expense for year 3 plus the accumulated depreciation, and that will give us our accumulated depreciation after year 3. Okay, ending book value, we're going to take our beginning book value of year 3 plus our annual depreciation of year 3, or sorry, minus our depreciation of year 3 to get our ending book value. To journalize our depreciation expense, this is an adjusting entry. We're going to debit our depreciation expense office equipment, and we're going to credit accumulated depreciation office equipment. Journalizing repair and maintenance payments. When a long-term asset is purchased, it's recorded as its historical cost, the actual amount that's paid for the asset. If the expenditure merely maintains the asset in its normal operation, it should be treated as an expense in the period of the payment is made. If the expenditure adds to the value or extends the useful life of the asset, it must be added to the cost of the asset instead of treated as an immediate expense. So here what we're looking at is if we had to have a repair or if we had to have a maintenance. Let's say that we needed cleaning done on whatever it is our equipment is. And it doesn't add any useful life to it or extended value to it. It just is simply cleaning that equipment. Then that would simply be an expense, normal operation. However, let's say that we needed to put a new motor in it, and that new motor then extends the useful life of it by 2 years. Then we need to add that to the cost of the asset instead of just being an expense because it changes the value of that asset. Number 1, which accounting concept is being applied when depreciation expense is recorded for plant assets? This would be our matching expenses with revenue. We want to record our expenses during the same fiscal period that we've earned revenue. Number 2, why is annual depreciation for land not recorded? Because of its permanent nature, depreciation is not recorded for land. Land is not going to depreciate in value for that reason. Number 3, what 3 factors are used to calculate a plant asset's annual depreciation expense? We need to know the original cost, we need to know the estimated salvage value, and the estimated useful life. Number 4, what should the installation of an elevator in a retail store be accounted for as a repair or an addition to the historical costs of the building? So in this case, the cost of the elevator should be added to the historical cost of the building. The addition adds to the value of the building. So this would be probably, it might be bringing it up to code in some cases, or simply it's going to increase the value of that building. So therefore, we would need to add it to the historical cost of the building. And last question, number 5, what's the smallest unit of time used to calculate depreciation? We normally do it annual depreciation. However, there are cases where we have partial year, so then the smallest unit would be a calendar month. That was the end of 7-2 lecture. You can now go to the 7-2 work together.